on the economy?
Yeah, I would say it this way. First of all, innovation is a positive thing. It brings with it many potential benefits: greater financial inclusion, more efficiency, greater options. Technology can do terrific things. In the financial area, the key thing is that equal activities, the same activity should be regulated the same way, no matter where it is, what kind of business it's in. That's one thing. Another is it needs to be regulated in a way that gives consumers and users of that service the protections that they need. And so they have to understand what the risks are, what they're doing, and that sort of thing. So I think with the growth of the non-bank financial players, we have some work to do to understand and deal with those challenges. In the meantime, we have the legal authority that we have over banks, really, also over some of the payment utilities, and we'll use that. But we don't have authority over many other companies that are now very much engaged in payments business and dealing with the public. And I think Congress is looking at the question of whether there's enough there, whether there's the sort of regulation and supervision that they need is really there.
Related to that would be cryptocurrencies, which is not quite fintech. Maybe some people might say it is, but cryptocurrencies have blossomed, mushroomed, depending on your observation of the size of it. It's hard to know exactly how big it is. Are you worried about the impact of cryptocurrencies in terms of the impact on the economy and the ability of people to use these things for nefarious purposes?
So a couple things. We think of them more as crypto assets because crypto, what people call cryptocurrencies, they're really vehicles for speculation. No one is using them for payments, for example, like the dollar. What they're using them for is to speculate. It's a little bit like gold. For thousands of years, human beings have given gold this special value that it doesn't have from an industrial standpoint, but nonetheless, for thousands of years, they've done that. So Bitcoin is much more like that, and the cryptocurrencies are much more like that. They're not really being actively used as payments.
Let me ask you about your own balance sheet. I didn't really follow up before. What is the size of the Fed's balance sheet at this point?
It's between $7.5 and $8 trillion total. That's it. I want to say 7.7, 7.8, something like that.
And so is that the highest it's ever been?
Yes. Yeah, it is.
And under President Trump, a legislation was passed giving you more authority to, in effect, buy securities, buy bonds. Have you used all that authority, or has it been taken away? And do you need any more authority to do anything you want to do?
So what you're talking about is the CARES Act. We still have CARES Act really gave us funding, which we needed, backstop funding to absorb any losses. We have the same authorities we've always had, but these are emergency authorities with a very high standard required for using them. It has to be unusual and exigent circumstances. Actually, what that means is it's an emergency and regular way credit intermediation has just stopped. And so that was the case for corporations and for states and municipalities, and we stepped in. We still have that authority. We wouldn't have been able to do the things that we did without Congress providing monetary backstop, fiscal backstops to absorb the losses, because we thought we were going to make trillions of dollars worth of loans. The truth is we didn't, because when we announced the facilities, the private capital markets started working again. That's what happened. Effectively, our facilities became a backstop, and pretty much right away, corporate bond markets and the municipal bond markets began to work ultimately very well. So we actually didn't have to make very many loans.
So let me ask you about the Volcker Rule. One of your predecessors, Paul Volcker, when he retired, later was upset after the 2008 crisis about banks doing proprietary trading and private equity investing. And so what was a simple concept became a very elaborate, I think, 300 or 400-page regulation. In your view, is the Volcker Rule working the way Paul Volcker wanted it, or the way that you're happy with it? And has it been an administrative burden for the Fed to oversee this?
So it's the law of the land, and our job is not to question that, but to implement it. So we've implemented the first try at the Volcker Rule in, I think, 2013. Then we came back, and I think we learned quite a bit from our first approach. It's a very challenging thing to implement. It's a simple concept that makes a lot of sense, which is if you want to do proprietary trading and sort of gamble with the house's money, Don't do that in a federally insured bank. Do it in a hedge fund or wherever you want. But so that makes all the sense in the world. Actually putting that in place and distinguishing between appropriate hedging activities and underwriting activities is not so easy. So we came back with what we think was what we know was a somewhat less burdensome and clearer provision of a rule in 18 or 2018 or 19. And we think that's working okay. And that was our intention, was to be faithful to the letter and the spirit of the law, but to make it less burdensome and more efficient.
Let's talk for a moment about something you said the other day in an interview, that when you come to work sometimes, you see people in tents, living in tents, homeless people living in tents. Your mandate is not to go solve that problem necessarily, but is there anything you think the Fed should be able to do or should be given more power to do to help people who are really suffering in the pandemic and related kinds of issues that hurt the people on the lower ends of the economic strata?
We're definitely not seeking any new authority, nor are we, as I mentioned earlier, we're not the agency that has the most direct authority over that. I just happen to see it, though, right here on Virginia Avenue. There have often been a couple of tents where at this end of town where there's some open space. But now it's big. It's a lot of tents and it's a lot of people, and you can't miss it. You drive by and you think, and it has to be because of the pandemic. It's grown a great deal, and it really struck me it strikes me every day as I go by it. So, how does that play into what the Fed does? I think we need to keep those people in mind. Really, we don't have tools that deal directly with them, but those are people. Many of them probably were working in February of 2020 before the pandemic hit. And I think they need to be in the room with us as we make our decisions about monetary policy. We need to be thinking that it's not just the headline in the aggregate, it's also the people who are at the margins of the economy. Just keep them in mind.
Speaking of the pandemic, as you assess the economy going forward, you are using the best economic models that you have based on prior experience, but those prior experiences often were before we had a pandemic. So how comfortable can you be that the economic models you're now using to assess where the economy is going to go is reflective of what is going to happen post the pandemic? And I assume you think that people are going to work somewhat differently post-pandemic. They may not come to the office as much or other things. How do you assess your economic abilities to assess the post-pandemic working environment and economic environment?
I think the first thing to realize is that the structure of the economy is always changing. So the economy that we had back in college was one where low unemployment led to high inflation, and inflation stayed high. It's very different now. And so we have to constantly update our thinking about the way the economy actually works. Now, bringing that to the present, we're coming back to a different economy. It's not going to be the same economy as the one we left. And we don't know exactly what that will be, but we have some ideas, and we're going to be finding out, I think, here beginning now. One of them is that there'll be more remote working remotely. That's one thing. Another is we've talked to companies and big consulting firms who surveyed companies, and many companies have spent the last year thinking about how they can use more effective technology, perhaps at the expense of the number of people that they need. So do their work with fewer people. And that's a lot of the service industry companies that have been traditionally big hirers of relatively low-skilled, low-paid people. So that's a concern because we still have many millions of people from those jobs who were working in public-facing service sector jobs. They don't have a lot of other skills or wealth, and so we need to be thinking about what they're going to do and how are they going to find their way back to the lives and the working lives that they had. And it'll be different in other ways as well. We'll be learning about that, and we always try not to settle on one model of the economy and think, oh, we really understand this, because it's ever changing.
So when you assess information about the economy, you obviously are gathering data all the time, and many of your predecessors really poured over this data with great fervor. Are you convinced that the Fed has the best sources of data? In other words, do you collect the data yourself or get it from other government agencies, or do you subscribe to private services? And do you think that the world has changed so much in terms of technology that the data collection methods that you have been using may not be as up to date as they should be?
Overwhelmingly, the data that we look at are collected elsewhere. some of it's collected by us, but the vast bulk of it, the big important things that you see, for example, the monthly labor market report, that's the Bureau of Labor Statistics. It's not us. So it's not like we're the CIA where we have a lot of private secret information about the economy. That's really not the case. More recently, though, things were changing so quickly during the pandemic, and the early part of the recovery from the pandemic, that there were a bunch of sort of real-time indicators of like Open Table is a good example where you could get data from and know how many people were using restaurants, getting much more high-frequency data, we call it. So that became much more important than it had been in the regular economy. So the data evolved. But the bottom line is that it's not so much the data. We're all getting the same data. It's really what you can do with it and the analysis. And I would say we have terrific, highly motivated, highly capable people, many of whom have been focused on doing this job, forecasting and understanding the economy for many, many years. So I think our analysis is as good as anyone's pretty much can be. It's pretty much state of the art. There are other outside groups that have excellent analysis too, and we read just to get a disparate range of views. We do read those as well.
To keep up with what the major banks are doing, do you call the CEOs of major banks, or do they call you with ideas from time to time, or is it done at a more junior level, so you're not really day-to-day calling Jamie Dimon or the equivalent?
I talk on the phone with a number of bank CEOs from time to time. In my case, it's always about higher level. It's about the economy, what you're seeing out there. And I would want people to call me if they see something that's worth talking about. I don't get into talking about regulation or supervision of their bank. There are other people at the board who do that, of course, but that's not what I do. They're in positions in our economy and our society where they see a lot, and I find it valuable to hear what they have to say about what's going on in the economy.
Let's talk about your life outside the Fed for a moment. You're a golfer. You weren't a single handicap golfer, you told me, but you're a golfer and you've played golf for a while. When you're chairman of the Fed, do people give you putts that they wouldn't have given you before? Is that very common or not?
I would certainly hope so.
Does that help you?
Frankly, just for the record, no, I don't. I haven't been able to play. I've not been able to play a lot of golf, unfortunately. But that's part of the deal.
And you are a bike rider, a cyclist. Isn't that dangerous for the chairman of the Fed to be riding a bike when cars are coming along, and you have a lot of strong people to protect you from cars that might be coming along?
I don't tend to ride on busy streets. I love to ride my bike, and I do commute to work sometimes, but I don't do it on heavily traveled streets or times of day when there's a lot of traffic, because that's whoever you are, you don't want to get hit by a car, Fed chair or not Fed chair. So I'm pretty careful.
And the most constraining part of your life now is it's just very difficult, leaving the pandemic aside, to really have conversations with people in the way you did before you were chairman of the Fed. You can't, talk to people about what you're working on at work so much. So what do you talk about, and how do you maintain your friendships?
I'm lucky to have some great friends, and it isn't such a great burden. There's plenty to talk about in the world, although there are a lot of things I don't like to talk about, like politics in particular. Try to stay away from that. It's a fine life, and I've got a great family as well. I have 4 brothers and 4 sisters and 1 brother, so there's enough to talk about just right there.
Do they laugh at your jokes better than they did before, or nothing's changed?
No, they don't laugh at my jokes, and but other people do. So, fortunately.
So, if you were an average person sitting in Dubuque, Iowa, or somewhere, and you wanted to know more about the Fed, what would you want to communicate as the chairman of the Fed to the average person who might be watching this about the Fed? Why it's a well-functioning institution? Why people should be happy about the Fed? And what is it that you would, I'd say, boil down about the essence of the Fed that you want the average American to know about the Fed and the way it works?
So I'll say 2 things. First, the Fed is a non-political, non-partisan organization that tries to serve all Americans in a way that's really important, to try to keep, to achieve maximum employment and price stability. So, a great jobs market and low inflation, 2 really important things. And that's what we do. We try very hard to succeed at that. But the other thing I would love people to know, though, is you hear about the Fed a lot. We get a lot of notice, and People write about us all the time. The truth is, the really important things about our economy are not things that we can affect. We have a relatively short-term perspective, a business cycle perspective on the economy in the things that we can do. Really what matters for the country's economy over the longer term are things like investment and education, which is investment in people, and having a more inclusive economy. So those are the things that matter for the longer run, much more than the Fed. So we get all this attention, but in reality, it's the things that Congress can do and that the private sector can do that will matter much more for people's children than what the Fed does.
Is it surprising to you that a system that was set up about 100 years ago, the Federal Reserve System, is still operating largely under the initial statutes, and that basically the way that it was structured then is more or less the way it operates today? Is that a surprise to you? And if you were sitting down today and given the power to redo the way the Fed operates, is there something you would suggest maybe could be improved?
You know, this was the third try at a central bank in the United States. There was the first Bank of the United States and the second Bank of the United States. And they basically failed because people didn't want to bestow a lot of power on a government agency in a major city on the East Coast. They were, the agricultural interests and the big country, they just weren't comfortable with it. In any case, both of those died after about a quarter of a century each. And then there was a long time without a central bank. The reason this one succeeds and is thriving, I think, is because we're balanced between a board of governors here in Washington, nominated by presidents and confirmed by the Senate with terms that are not coterminous with presidential cycles. So we're non-political. We're not part of the political cycle. But also 12 reserve banks all around the country who are deeply grounded in their communities and understand their communities, the states and the cities and towns where they are. So it's a much more balanced and sustainable model. And I think it really works. And I think, I think because of that, we keep in better touch with the whole country and what's going on in the whole country. So I wouldn't change. There isn't a fundamental thing about the Fed I would change. It really, I think it's a great model for this very large country. With quite a disparate economy and different regions and states. So I think it works.
As we get towards the end of our time, I'd just like to talk a little bit about lessons learned. You joined the Fed in 2012 initially as a board member, and later were appointed chair in 2018. I wanted to ask you, what have you learned as a member of the Fed board member that you didn't really know before that surprised you perhaps? And what have you learned about the pandemic and the way it's affected the economy that might have been a so-called lesson learned the Fed has learned about how the economy operates in a pandemic?
Well, I'm just about to have my 9th birthday here at the Fed, so I've learned a lot in those 9 years. I think you have to master the specific economics around monetary policy, and also you've got to master payments and regulation. So there's a lot to learn, and I went through all of that in my early years at the Fed and continue to learn a ton every day. So in terms of the pandemic, I would say this. The first and most important thing about the pandemic was healthcare policy, which starts with the things that we did to shut down the economy, not we, but the government did and that the private sector did to get the pandemic under control, and then to get people to socially distance, and then ultimately vaccines. All of that was and is more important than anything we can do. The second most important thing was fiscal policy. This was a situation where 30 million households are suddenly without an income, and Congress had to replace that. That isn't a matter for monetary policy. It works by stimulating aggregate demand by lowering interest rates. And that wasn't that would become important later, but that was not what was needed. It was fiscal policy. Fiscal policy came in and made the difference in this cycle. Then us, we were third, and I think we had 3 goals from the beginning. The first of which was just a stabilize thing, which I think we seemed to stabilize markets after what we did on March 23rd of last year, and also to provide some comfort and then support the economy when the expansion began, and then over the long run try to avoid longer run damage to people's working lives and to smaller businesses going out of business and things like that. So those were the things we tried to achieve. Clearly, we've learned a lot about the way pandemics work, and we hope to learn know more about that going forward because we hope to have no more pandemics.
So if somebody is watching and says, I really admire Jay Powell, he's working hard for the country and so forth, I'd like to be chairman of the Fed someday. What do you think are the skill sets that somebody should have to be a good chairman of the Fed? Should they be trained as a lawyer, get a PhD in economics, maybe do investing work? What do you think is a really good background to be chairman of the Fed? Like members of Congress, like other reporters? What is it you think is a really good skill set would make a good chairman of the Fed for a future chairman of the Fed, let's say?
Interesting. So I think if you look around the current membership of the Federal Open Market Committee, we have a pretty disparate group of people. There are people who were attorneys, people who worked in the financial markets. We have a good number of macroeconomists and non-macroeconomists. We've had people who are microeconomists too over time. So I think any background, I think you can do this job with any of those backgrounds. I think it really helped me to spend almost 6 years here as a governor before I became chair. So I did almost every job here under Chairman Bernanke and Chair Yellen. So I knew a lot about the operations of the Fed. I knew the people. So I think all of those things came together to make me comfortable in wanting to do this job in the first place.
So for those people who are wondering, how does one get to do an interview with the chairman of the Federal Reserve Board? Well, I have interviewed Chairman Powell before, but most recently it was a matter of coincidence, and I'll just end with that so you can comment on it. I had to go in early to see my dentist, and the only other person in early that day going in to see the same dentist was Chairman Powell. Of course, I knew when he was there that I wouldn't be getting my teeth cleaned as quickly as he would because he'd be ahead of me, so that's okay. No problem. I understand Washington. But had we not met that dentist, we might not have gotten this interview. So I want to thank you for using the same dentist that I've been using, who's a very good dentist. And thank you for agreeing to let this interview go forward. And I appreciate your hard work and your public service. And Jay, thanks very much for doing this.
David, thanks very much. Always a pleasure. Great to see you. See you at the dentist.
Okay. Bye.
Bye-bye.
Okay, well, thank you all.
All right, that was David Rubenstein at the Economic Club of Washington, D.C., at least virtually, talking with Fed Governor Jay Powell. Are we back? We're back. Okay, that was David Rubenstein at the Economic Club of Washington, at least virtually speaking with Fed Governor Jay Powell over the last hour. Fantastic interview. A lot of really interesting stuff that we learned from the Fed. He tried to get a lot more out of him in terms of his sequencing plans and in terms of his thoughts on debts and deficits. But Powell has stuck to his knitting, really, in saying that the Fed has mandates from Congress and works for Congress. He has not yet met with President Biden, though he does talk regularly with Janet Yellen, the Treasury Secretary, and says that they have a good relationship. Talking about his key lessons from the pandemic, he talks about the importance of fiscal policy, and says the Fed's regional structure is why it succeeds. And then at the end, some interesting stuff about what you can do if you want to be Fed governor eventually. I think the key is to work at the Fed for a while. He said he's done every job there, and eventually you learn the skills you need to run the central bank. We are also very focused right now on Coinbase. We are hearing that it's closer and closer to trading live. We've seen a number of indications, including most recently an indication that it would open at $376. That's come up a long way from the $340 where we kicked off, and the $250, which is the reference point from the from the NASDAQ. Let's get right over right now to Sonali Basak and talk about what we can expect in this, the largest direct listing, Sonali, if I understand, the largest direct listing in history.
Yeah, it's a huge direct listing, right? And for NASDAQ, it's really being put to the test here. I was joking around with some of my sources and saying, are you worried about another Facebook moment? At $379 a share right now, that is just shy of that $100 billion valuation that we've been looking for. And as we know, the beauty of a direct listing is that retail interest that you get on top of that institutional interest that is really the landmark of an IPO. That retail interest is what we're going to be really looking for, because that's what's been driving Bitcoin higher, and it's what we expect to help drive Coinbase higher as well. Matt, there's some big Wall Street names also behind this, right? In addition to the venture capital names. Andreessen Horowitz, as we know, we spoke to Initialize Capital's Gary Tan, but also Tiger Global. So this is a big validation for those investors, you know, regardless of if it is just a little shy of 100 billion or not.
Well, and massive validation, I think, really for the entire crypto community. If, you know, there are a lot of them who wouldn't like to see this move, but a lot of them feel that now institutions and experts have been poo-pooing crypto for so long, and this kind of brings them into the light. I want to take a moment to say goodbye to our radio audience from me, because Charlie Pellet will now be taking over on Bloomberg Radio, and he's going to bring you through this Coinbase listing, direct listing, the largest, as we've said, in history, indicated right now at 379, although we've seen it bouncing back and forth, 376, 380, 379, as Shonali Bassick just said, right around $100 billion valuation. And I was talking earlier with Meltem Demirs on Bloomberg Radio, Shonali, of CoinShares, but she founded the World Economic Forum's digital currency organization. She teaches at MIT as well as at Oxford, and she said she thinks this will have a $150 billion valuation by the end of the week. That puts it, of course, at a much larger market cap than even Goldman Sachs. What are the major Wall Street banks saying about this listing, which has really taken the spotlight in some ways from JP Morgan, Goldman Sachs, and Wells Fargo?
Yeah, there's a chance it could be bigger than both Goldman Sachs and Morgan Stanley by the end of the week, and it's bigger already than most European banks as well as U.S. exchanges, right? It's interesting because we know that Intercontinental Exchange had exposure to Bakkt, another crypto exchange, but then, you know, it made me wonder also, why didn't any other type of exchange try to get exposure to Coinbase? You know, Goldman this morning on its earnings call was asked about crypto and would it create digital wallets or crypto wallets. David Solomon, the CEO of Goldman, had said, you know, we're focused on creating a digital bank with no plan for a crypto wallet right now. Plus, there are regulatory constraints for the big banks to get into it in a bigger way. They're offering their institutional clients it, but, you know, it's years late, right? The question is are those institutional clients and those high net worth clients going to stick with these crypto players that have gotten into the asset class sooner?
We have seen the price of Bitcoin rise today to another all-time high. At one point, it traded at almost 65,000, I think 64,867 or something like that. Right now, it's trading at $63,477. Of course, we've seen other coins trade higher as well. Ether, for example, is a big winner today and has done even better than Bitcoin over the last 12 months. But this is a market cap on its own, Bitcoin, of I think $1.2 trillion. If you look at all of the major cryptos, you get a market cap of well over $2 trillion. And we have now nations, the EU, for example, talking about their own digital currency. The ECB talks about that a lot and has talked about it more recently. How is this Coinbase IPO going to push the acceptance of cryptocurrencies places it's never been before?
You know, it's really funny because just this morning you had Mark Cuban tweeting about Dogecoin because the Mavericks now take it as payment. And he was saying, we're holding on to our Dogecoin, so don't you worry about it. To your point, Bitcoin and Ether for Coinbase alone is more than 50% of the trading volumes. But does that start to change? Another company that agreed to go public this year is eToro, which is known for its exposure to the crypto universe as well. We asked the CEO at that time what else people are trading, and he said other coins like Ether and Cardano. So you're right, that interest among the mainstream Bitcoin community is also going to other coins. But to your point, how fast can central banks get on it? And how quickly can it be adopted as a form of payment rather than just a store of value?
What's the difference that we've seen here, Shanali, or what are the lessons to be taken? A direct listing, they wanted it to be more democratic compared to an IPO where you have to know somebody who knows somebody and get syndicate. What's the experience that we've had now with this direct listing?
Every time it seems to get smoother, right? It opens later than a traditional IPO, but the retail interest is significant, and as is the venture capital interest. Silicon Valley likes this a lot better in a lot of ways. Goldman Sachs, JP Morgan, they're involved in the Coinbase listing. Morgan Stanley has been involved with most of them in the past. The player that's not as deeply entrenched in this process, since it's on NASDAQ rather than New York Stock Exchange, is Citadel Securities. Citadel Securities was the designated market maker for the last sets of major direct listings. In this scenario, NASDAQ does a lot of that price discovery on their own with the banks.
Do direct listings always take this long? I mean, typically an IPO on the New York Stock Exchange would take, a half hour, maybe 45 minutes on the long side. I was down there for a number of them, Ferrari being my favorite. But of course, we've seen IPOs drag on. Facebook was fairly disastrous on the NASDAQ, but even that didn't take this long. Is it just the size and the style?
No, it takes longer to list a direct listing on any exchange. I say don't wear heels when you go to the New York Stock Exchange or NASDAQ on a direct listing day. Listen, everything that would have happened over the span of weeks, a lot of that is now happening in real time. Some of it is happening in the last couple of weeks while banks and others try to get a sense of what investors are going to do today. But at the end of the day, especially when you have so much retail interest that it's hard to account for, even in a traditional IPO, think about the pops we've seen this year, Matt. They need to be ready for that, right? You want to keep prices relatively stable at the end of the day.
I'll also tell you, on the New York Stock Exchange, no running, Shanali. That's one of the most important rules. No running on the floor of the New York Stock Exchange. Shanali Basak there talking to us about the Coinbase direct listing. We're still waiting for the first live trade. We've been getting indications, as I said, around $380, $379. We'll see where it opens, but right around that $100 billion valuation. Let's get over to Ritika Gupta right now. She joins us with our stock of the hour. Ritika?
Thanks, Matt. Of course, it's Coinbase. This is the only story. Forget bank earnings. Dan Ives of Wedbush calling this a watershed moment here for the industry. We're all anticipating it, really, for this listing on the NASDAQ here, because we all want to know what this is really worth, because this is the first time a major cryptocurrency company is listing in this way. Now, the reference price, the reference listing was $250 per share, but of course this is the listing reference, as its name suggests. The shares won't be actually exchange hands at that price, but now we've been monitoring those price indications throughout the day. The latest $379, $380 per share, just putting it shy of that $100 billion market valuation. And why this all matters? Well, this cryptocurrency exchange, of course, is a way to regulate this industry. It's a mainstream way for investors to invest in this digital currency here. But of course, there is a risk, being that its fate so closely tied to the performance of Bitcoin. And Bitcoin, we know today, sitting at fresh record highs, going past $64,000 there. And this crypto market cap at $2 trillion.